Hello everyone, welcome back to another webinar by Indiabulls Securities. I am आकांक्षा कुमावत और आज का वेबिनार बहुत ही स्पेशल होने वाला है जिसमें हम पीएमएस और एआईएफ्स के बारे में बात करने वाले हैं। मैं आप सबसे रिक्वेस्ट करूंगी कि आप चैट बॉक्स में हाई ड्रॉप कर दें सो दैट आई नो दैट आई एम क्लियरली ऑडिबल। Hello everyone, good evening. Just drop a hi message in the chat box and then we can begin with the session after a few minutes. Hello, I can see people joining over here. Please drop a hi message. Hello everyone. We'll wait for a few more seconds and then we can begin with the session. Hello everyone. Okay, I believe we can start with the webinar. So hello everyone. A very good evening to everyone present over here. I am Akanksha Kumawat and I welcome you all to another webinar by Indiabulls Securities. आज हम बात करने वाले हैं एक ऐसे टॉपिक के बारे में जो सीरियस इन्वेस्टर्स के लिए काफी इंपॉर्टेंट है और वो है पोर्टफोलियो मैनेजमेंट सर्विसेज यानी पीएमएस एंड ऑल्टरनेटिव इन्वेस्टमेंट फंड्स यानी एआईएफ और व्हाइट ओक कैपिटल कैसे अलग और इफेक्टिव है। ये दोनों ही इन्वेस्टमेंट ऑप्शंस अब इंडिया में काफी पॉपुलर हो रहे हैं और आज हम समझेंगे कि ये कैसे काम करते हैं, इनकी स्ट्रैटेजीज क्या होती है और कैसे आप इन्हें अपने लॉन्ग टर्म वेल्थ क्रिएशन का पार्ट बना सकते हैं। और इसी टॉपिक को बेटर समझने के लिए हमारे साथ आज जुड़े हैं मिस्टर नीरज हरलालका। ही इज हेड ऑफ बिजनेस इंटेलिजेंस एंड सेल्स प्रोसेस एट व्हाइट ओक कैपिटल. He has around 20 years of experience in product, business strategy and management and sales and distribution. So thank you, Niraj sir, for joining us today. I'll hand it over to you from here. Thank you, sir.
Good evening, everyone, and welcome to this webinar on space on the alternate investment. Do let me know if, Akanksha, if you can see my screen.
Yes.
Right?
Yes,
Yeah.
sir. Your screen is visible. You are audible.
Yeah, so thank you. So, it's a very interesting space. Over the years, we've tried to really understand what the alternate space is and how the framework works. Uh, you know, Actually, it is all about risk management. Today, when you look at it, a mutual funds versus a PMS or an AIF, it is how you manage risk at a various level, right? If you were to see how the SEBI regulations also have framed over the period, mutual funds, as we call it, are straitjacketed. Today, if you are running a large cap fund, you have an 80% of the large cap index that needs to be there, a mid cap 65, a multi cap 25% each in large, mid, and small, so on and so forth, right? And each one requires you to the reason why these limits or guidelines, if I were to say, have been incorporated is nothing but to ensure that the correct risk is delivered to the investor that they are coming in for investing with, right? At the same framework, if you see what on the alternate space, when you're looking at a PMS, which is again a minimum of 50 lakh minimum ticket size, or an AIF with a minimum ticket size of, and I'm talking about category 3 AIF here, a minimum ticket size of 1 crore. What essentially we are doing is saying that somebody who's putting in 50 lakhs has a certain amount of portfolio, and hence has the ability to take certain risk. And within that AIF also, that if he or she is putting in 1 crore as an investment, they have a certain amount of risk appetite that they can invest in, right? And in the same regulatory allows you, in a PMS, there may not be a cap of 10% like we have in mutual funds on a single stock. So it allows you to take some more risk. And in an AIF, what you do is basically you can also do long shots and certain kinds of leverage, if I were to use that word. So it gives you, allows you to take more risk on the portfolio. So ultimately, I think it's all about risk management in a mutual funds versus a PMS versus an AIF, right? Now, if you were to look at, let's say, an example of a small cap mutual fund versus a small cap biased AIF, right? In a mutual fund, you are governed by the benchmark that is there. There will be daily flows that will come in and go out, where the fund manager has to manage the liquidity that comes in and goes out. You have to have awareness of the benchmark on the sector weightages that is there. AUM can be substantially large in mutual funds, where in an AIF, it will be 1,000 clients with a certain amount of AUM. So not saying that a mutual fund is bad, but the risk on an AIF is far different from a mutual funds, right? Then in an AIF, you get to take some unlisted stocks where there will be certain restrictions or regulations around when you take it in um, a mutual fund, right? So essentially, each one is correct in its own way. It just serves a different risk appetite for one to the other. So what we will do first is, just talk about how at White Oak, what is our investment philosophy and how do we go about picking our stocks and what is the culture. And then I will, maybe talk about how we construct each of the portfolio that is there. So our, we as a group today are close to $10 billion and an 8-year-old firm that is there, and 2/3 of the money that we manage is offshore, with 1/3 and onshore. And the type of investors that we have is from institutional to retail, family offices, etc. That is there. Now, what is our investment culture, right? Our investment culture, which is the performance first culture, is based on four philosophies, based on four pillars. One is the philosophy, the people or the team, the process, and the balanced portfolio construct. Our philosophy is quite simple. It is a bottom-up stock selection process where we look at identifying great businesses at attractive value to buy, and we like to invest in businesses and not take any macro bets, because it's really difficult to predict macros that is there. And even if you were to predict the macros, you really don't know how the markets will react to that. Along with that, I think the one of the most important aspects of investing is the people or the team. And today at White Oak, we have one of the larger investment teams that is there. And interestingly, this team has been experienced in the global market also, because there will be a lot of patterns that you will see in multiple sectors that are there across the globe, that gives you an edge to invest in. Plus, every human being has two characteristics in some at the margin. You will have certain biases that human beings carry, and when you have multiple people in the team looking at it, you try and reduce those biases. And secondly, there could be blind spots that everyone carries. Again, when you have multiple team members that look at investing, you reduce those blind spots that are there. Along with that, we have our time-tested process of identifying or evaluating companies, which is called the OPCO FinCo framework that we utilize, which I will talk a little bit more on details. That is a third pillar. And the fourth, which is again a very important aspect, is a balanced portfolio construct, where you look at the top-down bets on macro factors, and you ensure that the performance comes from stock selection and not just an being in the right place at the right time, right? So our philosophy, which is there, what are the attributes that we look at? First, to identify a great business, there are three attributes that we are really looking at. Superior return to incremental capital, scalable long-term opportunity, and a strong execution and governance. Uh, the first one, superior return to incremental capital, is really talking about how a company can sustainably have make money more than the cost of capital over time, right? This also gives you some insights into what is the competitive advantage that the company has, and is it sustainable or not. The second one is basically, it tells you, is the sector one of the growing sectors? Can that sector grow, and can you take market share, right? And today in India, we see multiple sectors growing, and there may be a few companies or many companies that have that edge on taking that market share, and which is what you would want to really target, those companies which can take some market share that is there. And the last, I think, is the 2 points which are critical, which is the strong execution and governance, right? Today, this is where the team comes into play. The large team that we have really starts meeting the management and understanding what's happening. We end up more than 3,000 meetings in a year, meeting the management, promoters, competitors, customers, suppliers, ex-management, market research, factory visits, etc. It really gives you an overall picture on what the company does, right? And in most often than not, what you will see that the leaders in a sector or an industry that are there are more probable because they had a very strong execution on the business plan, right? It's not usually the capital that makes you successful, but the execution plan that is there. And the second aspect is the governance, which we believe is the most critical aspect of a great business, because we've seen many and more examples in this country and across the globe where great businesses have toppled because the governance aspect has not been very great, and people have capital is lost more than returns. So I think these three aspects of great businesses is critical. And then you also look at the valuation model, where we use our own OPCO-FINCO framework, where you start distinguishing the finance cost versus the operating cost, and try and gauge the excess return to capital over free cash flow, which identifies where the opportunity lies in, right? I won't dwell into this a little more. We can always get into details later. And then, once you start putting these filters, we have more than 1,300 stocks with 1,000 crore market cap that we in our universe, which we start filtering with, and which boils down to about 300 to 400 great businesses, as we call it. And then when you start looking at attractive valuation, you could find 50, 80, 100 or companies that you invest in over time that are there. You will see that at White Oak, especially on the alternate space, we are a lot more biased towards mid and small cap. Now, one of the reasons why we have that is when you start doing the opportunity funnel, you find higher inefficiencies in the mid and small cap that is there. And if you have a very strong team with your own research that is there, you will find that you can find a lot of opportunities in the market that is there. Along with that, when you start looking at certain opportunity funnel based on certain factors like poor governance, macro variable, or highly regulated companies or sectors, relative to certain companies or sectors which are better governance, where companies are more variables are the business than the macro variables, and not so heavily or lightly regulated, you will find that those opportunities are much better and more lucrative over time to find alpha in the market that is there. So, when you start looking at these parameters, you will construct various portfolios that is there in the market. Now, if you look at, so to stop, now just to summarize where we are on the risk, you've understood how we really try and gauge and form look at companies that is there. When you then is all about constructing the portfolio. Today when we look at our PMS, you will see in our pioneers that there are certain factor risk that we do take, right? So you will have, we can be underweight certain sectors or where we wish, where we think that the opportunity may not be very high. We can be substantially underweight, or can be overweight certain sectors also, where we find a lot more opportunities that are there. And it gives you an edge on trying to find those opportunities in the market. Now, when you move away from the PMS into an AIF, and just an example, we
Uh,
have our
Hello.
small cap biased AIF that is there. Now, when you look at the small cap
Hello,
AIF,
sir. Sorry to interrupt. Your
you
screen is
compare
not.
it to a mutual fund, just for an example. Like I said at the start, right? In an AIF, I am trying to give a higher risk reward to an investor because that's what they may be looking for. And in a mutual fund, relatively, want more consistent return that is there, but an alpha for sure. Now, you do have some challenges when it comes to running a mutual fund versus an AIF, right? You, like I said, you will have flows that comes in on a regular basis. Where in an AIF, I have that opportunity where the flows are not on a daily basis. I am not sector or constrained by the benchmark so much. Interestingly, I can have a number of the weightage on the stocks can be substantially higher when on the AIF side we can take. And last but not the least, I think the AUM that you would have in an AIF would be certainly slightly limited compared to, and gives you that opportunity to hunt for more ideas. And last but not the least, when it comes to unlisted, we have an opportunity to take more on the AIF there also. And in that same breath, if you look at the AIF that we have on the healthcare space, right? We have a healthcare mutual fund also, but we have an healthcare AIF. The whole distinction between the two basically is the more risk that you are able to take on AIF. The sizing of each particular stocks can be much more in an AIF that is there. There will be certain stocks which will be a part of benchmark, where you will be underweight in a mutual fund to give more consistent return and take less risk. But in an AIF, I have that opportunity of trying to be taking more risk that is there, and trying to give a larger alpha that is there, because risk and reward basically is something that always goes hand in hand, that is there. So today what you need to assess in before you get invest in any of these kind of ideas or products, I think what you should look for is the risk appetite for your there are you is it suits your risk. What does the fund really deliver? Does it deliver what you're looking for? You like a flexi kind of a product, you like a thematic, and blend all that, and you will see that there are times that will have an outperformance that we can deliver on a PMS versus an AIF, right? So it's all about elevated risk. Regulator also encourages some amount of risk in certain products, and that's how the various norms or regulations are made. and this is what you are trying to look at the end of the day, right? um, I think we will like to keep it a lot more interactive, so I'm happy to take questions because we've started to get a few questions. uh,
Hi, sir. Can you hear
Akanksha,
me?
if you're okay, can we start taking
Yes,
questions?
yes, sure, sure. I hope I'm audible, sir. Hello?
I think Akanksha's connecting, but till then, I think Rohit has. Yeah, Akanksha.
Yes, I'm audible to you, right?
Yes.
Actually, towards the end of your PPT, your presentation was not visible, but okay, we'll go forward with the
No,
questions.
I switched off the presentation because I was
Okay,
just
fine,
talking
fine.
about general. Yeah.
Okay, okay. That's okay. So, Rohit is asking, sir, how are changing market conditions like interest rate shifts or global volatility impacting PMS and AIF performance?
So, Rohit, see, any of these conditions, firstly, at White Oak, we don't really look at macro factors, right? You do understand and see what macros are going on, but you will not make an investment top-down decision saying that if there is an interest rate shift, where should I invest, or what is you can't do that. But yes, you are aware of it when you are doing a bottom up stock picking on how these companies may get affected, right? Now when it comes to investing in any of the investment products, be it a MF or a PMS or an AIF, global volatility will always, or interest rate shift can have an impact on the stock specific stocks, right? And as it does, you will have an impact on each of these products. But what happens, it's all about the construct of the portfolio. So like I mentioned, if the risk of the factor risk that you take in a PMS is higher than in a mutual fund, you may have a slightly more volatile volatility in your PMS. And if you're going to take a slightly more risk in the AIF, certain factors can have a little more volatility in that. But the whole point is about taking that risk and reward, right? I say jokingly, the first principle of economics is risk and reward go hand in hand, right? So if you were to take more risk, i.e. volatility will be high, right? And certain factors can have, but it's really not predictable on interest rates, how the markets can behave. So we don't take a top down approach in that front.
Okay, sir. So, next question we have is from Udesh. He's asking, how do you see the PMS and AIF industry evolving in India over the next 5 years?
So a great question, for sure. I think we see this grow substantially because today more and more investors are entering the market. Today, we as a mutual fund industry, we've crossed 70-75 lakh crores. And like I said, mutual funds will be suit a certain level of risk that the investors are looking for. And as portfolios mature and people get more have more appetite for risk, they will venture out into different ideas that are there in the market, and which will only grow this market. We've seen how AIFs over time have grown in the country. Interestingly, I spoke about only AIF category 3, right, which is where you can do, but category 2, where unlisted space is very high, and in India has, that market evolves over time. That category could also become a substantially big, right? So I think we are scratching the surface. Raising capital in various forms and serving various risks will always be good for this country, good for the capital markets, and I think this is one of the few avenues that will help investors tap those opportunities, if I were to say.
Okay, sir. So, next question we have is from Praveen. He is asking, what are some common mistakes investors make while choosing a PMS or AIF product?
Yeah, it's again a very, very interesting question, right? I think firstly, I mentioned this previously, and it may sound repetitive, but the the first assessment you should do is understand what the intent of the product that you are trying to take, right? By be it a PMS or an AIF, what is the philosophy? What is it intending to do, right? What is the risk that these products have? And if the risk is elevated, does it suit your risk appetite or not, right? Because you never know which time of when the market's correct, right? And if there is a larger erosion of capital that is there in either of these products, are you able to withstand that over a period and ensure you are sticking around in those ideas over time when the market turns around and gives you that, right? Because factor rotations happen, industry sector rotations happen, market cap rotations happen, right? All these things are part of our market. And please understand what the fund managers are trying to do, or what the fund house is trying to do, and match that to your requirement and aspirations that are there. Again, if I may use an analogy, in school we used to have this a test, right? Match the following. Now, I think that's exactly what you need to really do, if you ask me, right? Understand the product, the risk, the ask from that idea, and does it really fit into your scheme of things? Obviously, consult your advisors, and they'll always be helpful for that.
Yes, so that's great. I would like to tell the audience that we are still taking up the questions. So if you have any questions, आप उन्हें chat box में डाल दीजिए. We'll wait for some time if we get some more questions, and then we can take it forward.
Yeah. See, I think maybe I'll share my screen, and
Sure, sure.
a couple of things I don't mind sharing as we speak. See, you need a lot of active fund managers to do, take care of your portfolio, right? Now, but I hope you can see my screen.
Give me a minute, sir. No, sir, your screen is not visible yet.
It's showing screening. Just a second. Let me. I don't know what happened. Apologies for this. Nakangsha, has it come up?
Not yet, sir.
Okay, so while it does, right, let me try and address this. You can get data, interestingly, if you look at the number of, or, the average number of analysts covering stocks, uh, if you were to see in the large cap space, which is up to 100, you have about 30 to 27 of them, average analysts that you may find in the market. But when you start looking at the mid cap space, which is the 101 to 250, the average will be 15, 16 average analysts covering the stocks. But when you start going down the chain, right, it actually gets into single digits and even lower. So I think identifying in-house research capabilities makes the difference, and these become that much more important or warranted as you get it into PMS or AIF, because these are where you try take some more efforts into sizing and taking more riskier bets that are there. So I think these things are important to assess. Somebody asked that question, why, what are the common mistakes that are there? I think look at houses which have a very strong in-house research capabilities in identifying stocks when it comes to the PMS and AIF especially.
Okay, so that was great. I guess we are done with the questions here. Yes, we are done with the questions. Give me a minute. Yes. So, thank you, Niraj sir, for explaining to our audience about the PMS and AIF and how it is managed by WhiteOak Capital. I would also like to thank the audience present over here for joining the session. And SAE or webinars के लिए follow Indiabulls Securities on Instagram, Twitter, Facebook, and YouTube. Thank you, everyone. Thank you, sir. Thank you so much for enlightening our audience about that. Thank you. Thank you so much, everyone. Have a good day ahead.